What is going on, everyone? Welcome back to the Retire Ready podcast. My name is Colin. I'm here with Kyle, and today we're going to jump right into the show. What we're going to talk about is a current client of ours, but when they came to us after watching our videos and hearing about our classes, they came to us and they sat down with us for the first meeting and they talked us through their situation. So we're going to kind of walk through what they were talking about, where they were when they came and sat with us, and then the plan that we had created for them. So where were they when they came and sat with us in our office to tell us, where they were currently? They're a married couple. They're both age 65 years old at the time, and they retired in January of 2023. They had $1.5 million, and that was all in tax-deferred accounts. So they had a huge potential tax problem there. They told us that the income that they needed or they were looking for in retirement was $7.5 thousand per month after taxes, but they weren't really sure, how much they could spend. That's what they were looking to get. They had not claimed at the time Social Security yet, so they're looking for some Social Security claiming there. And they were currently working with a large wirehouse, a large money manager, getting that diversified pie chart, so potentially looking for some more comprehensive planning.
So a couple comments here on this household. If I could clone this household, this is very common to the type of people that we work with. Is they kind of, not the same concerns, but pretty general in nature of everything's in pre-tax or majority's in pre-tax. I only have pie charts in the Social Security statement. And maybe I always tell people too, like, everybody has an advisor. So whether you're doing it yourself, you're really paying, you are the advisor, you're paying, yourself to do it all. And like, what's the cost of doing that and the time involved? But, they were involved with a very large wirehouse, and with, big pie charts, individual stocks. And so, like half of the clients that we even build plans for, and half the clients we do ongoing planning and investment management for, come from these types of environments. I'm very familiar with what people are seeing and what they have, and that's why we're preaching and educating on this show and in our classes, because that's what's adds the most value to someone's situation, is basically being able to show them and tell them, kind of getting all this financial jargon out the way and clearing out everything to kind of really say, here's all the value adds that you need to have from a planning perspective, and here's some stuff you might not be thinking about.
And when they came and sat down with us, they had 5 primary concerns for their retirement planning that they were, concerned about, and we're going to walk through each of those individually. So the first one was, when and how should they claim Social Security?
Yeah, you can go on Google and type in, when should I take my Social Security? And you're going to get hundreds of opinions and then all this different stuff. There's going to be the crowd that says delay, delay, delay to get more. There's going to be the crowd that says take it early and maybe invest it, or take it early so you don't take as much from your investments. And we're in the crowd of always making an educated decision, and that's why we're a big believer in building out true, real financial plans and giving it advice, because there's not like one right way to do it. From married couples to single, it comes down to like, what's your spending strategy? What type of tax planning are you going to do? What's your longevity look like within the family? Are you married? Is there going to be income loss? Do you have pensions? So there's a lot of things, but again, we come down to like, how should you take it around your assets? And more than likely, we're going to lean into the tax and the math, versus we're trying to like remove the crystal ball as much as possible, without making these types of assumptions or making the planning decisions.
Yeah, their second concern, like we'd mentioned multiple times now, they were with a large wirehouse, large money manager, and so they were just getting those diversified pie charts, and they're looking actually for more comprehensive financial planning, tax planning. So that was their second concern, was looking for that more comprehensive planning for their retirement versus just a diversified pie chart.
Again, most people have their money invested somewhere. It could be in a 401k, it could be through a large wirehouse. When we talk about large wirehouses, basically looks like this. They own football stadiums, or you're driving down the street wherever you live, on the main roads, and you see their big signs out everywhere. Those are what large wirehouses look like. So you basically get thrown into a proprietary model before you even met them. So you're going to answer risk profiles. It's moderate. Boom, you get thrown in a moderate portfolio, and there's nothing wrong with that. Your money will grow. It has grown, and it would continue to grow. This household just decided they want more than that. They want to do the planning and the investments and the taxes and the income all together. So it's all working cohesively, and they want to basically make sure they're paying full price and they get full service for the next 30 years of their life. They want that partner that's going to kind of do all that for them versus like just pie charts at the wirehouse.
The third concern, like I mentioned earlier, they came to us, they sat down, they said, hey, we would like $7,500 per month net after taxes for retirement, but they weren't really sure. They were asking us, they were wanting to know, how much can we spend in retirement?
Very common. So that's probably like the biggest question people have is like, what can I spend? We don't really like to do the plan as like goals based, where we're like, hey, we want 7,000, build this plan. We like to do it to show people like what they could be spending. They don't have to spend that. It might be less, it might be more than what they want. So we're gonna build a plan to basically make sure like, hey, are you spending in the right capacity? Are you overspending, underspending? That's basically saying, hey, this is what they wanted to maintain their lifestyle, but like they wanted to, run the numbers to make sure, hey, I only get to retire one time. Am I doing this correct? Or how did I even come up with this number? Did I make it up, or did the wirehouse run a Monte Carlo scenario and said, hey, withdraw 8 to 10% of your withdrawal, of your savings per year early in retirement?
Their fourth concern was, we would all love for the market to just go up always, but that's not always the case. The market does go down, and they were concerned and curious about what were those adjustments needed when we get to a down market.
Yeah, so they're coming out of 2022, which was, everybody knows what the market was like in 2022, and now they're retiring in 2023. And now they're basically have that in the back of their mind saying, okay, what happens when the next 2022 happens? When is that going to? I don't know what's going to happen. Their wirehouse doesn't know when it's going to happen. They don't know when it's going to happen, how fast it's going to drop, and how long it's going to last. So that in the back of their mind is saying, okay, when the next one happens, what adjustments to our spending do we need to make? And they would rather know that before it happens, and then what that adjustment looks like. And that's what our plan is going to basically our planning strategies and planning philosophy is going to line that up for them.
Yeah, and then their fifth and final concern, like I mentioned earlier, they have about $1.5 million, and that's all in pre-tax money, all in tax-deferred money. And so that was a big concern they had was, what do we do with all that pre-tax money? How do we, withdraw it, distribute it in a way that is the most tax efficient?
By the way, congratulations, you've done a great job at saving 1.3 to 1.5, 1.6. Obviously the markets will move that. You've done a great job at accumulating assets and getting up the mountain. You've had time on your side to grow that. And now we're going to talk about getting down the mountain. We can call it decumulation, we can call it distribution. Every step you take, you got to be careful. You don't have to be fearful. You just got to, be ready so you don't have to like get ready. Obviously that should be a very big concern, is having too much in pre-tax. Hey, what happens if taxes go up? Hey, what happens if markets go down? This household, if the markets were to go down, just to get their net income, they're going to have to sell more shares just to get the same amount of income. So they're going to be selling more shares at a loss. That should be a concern. We need to start addressing it through a plan.
And speaking of taxes, the lack of tax planning is the difference between the taxes that you will end up paying and the taxes that you could have paid. And so with a comprehensive approach, the objective is to minimize taxes paid over your lifetime, minimize, paying more than we should be paying in taxes over your lifetime. And so, we want to talk through a few tax mistakes that could impact your retirement. So the first one here is assuming that you will pay less taxes in retirement.
Yeah, so let's take a step back. And when we're going to talk about tax planning and incorporating this into retirement, we kind of have to understand like pros and cons and mistakes that could be floating out there. So the first thing we want to do is be educated on why we shouldn't assume we should pay less in taxes in retirement, because that's necessarily not true. What we want to do is build a plan where you pay the least amount of taxes cumulatively in retirement. And we're going to basically look at some tax reduction strategies, whether that's early in retirement or later in retirement. And for most individuals, basically for this household, it's going to be from some type of Roth conversion strategies, basically starting in 2024.
The second mistake that could impact your retirement is just not even planning for social security taxation at all.
Very common. Most people have an idea of Social Security and that it is taxed up to potentially 85% at your federal rates. But now we're going to basically take a step back and say, is there anything we can do from a planning philosophy and implement some strategies so that in the future our Social Security is not taxed as heavily? So just think about this. If there's $80,000 of Social Security coming in for the household, and 85% of it's taxable. What if there's some plans you can do to where it gets it down to like half of it's tax and half of it's taxed federally and half of it's tax free? What does that do to your investment plan from withdrawal rates? Does it allow you to maybe spend more? Does it allow you to take less out so you keep more shares invested? So those are some things that I think people might be overlooking.
Yeah, the third mistake that could impact your retirement is if you have the chance to, meaning you have some years until you retire and plan to make some withdrawals, you might forget about Roth IRAs or Roth 401ks.
Yeah, so maybe not for this household, but for our listeners and viewers, if you have some more working years ahead of you, or maybe you're retired but your spouse is still working, I would say don't forget about potentially funding Roth IRAs and maxing those out in the private sector. But also Roth 401ks, if you still have 4, 5, 6, 7, 8, 9, 10 years and you can max out $30,000 of contributions per year in your Roth 401k, it might make sense to do that. We just want to make sure you're not overlooking that potential mistake.
The fourth mistake that you could make is just ignoring taxes altogether.
Yeah, big no-no. Focusing on just your investments. I know that's basically the next mistake I'm going to take it for you is you're focusing on the return on your money, not the return of it. So most people accumulating are just looking at their pie charts, their values going up. Hey, this big wirehouse must be doing something right. I'm making money, right? Yes, the market goes up, your diversified pie chart's going to go up. But we can't ignore taxes. We have to start figuring out the return on that money in the future. At the end of the day, that 1.4, that $1 million account, that $4 million tax-deferred account has a minority shareholder on there. As that goes up, so does your tax bill. So we have to basically focus on the return of that as Social Securities and pensions and IRAs and Roths and capital gains, having this all work together.
Yeah, then the sixth and final mistake is when it comes time to make those withdrawals and start taking withdrawals from your accounts, especially your retirement accounts, doing that in the wrong order.
Yep, and there's not a right or wrong way. We just have to basically map this out and be able to show you, hey, if you were to take your money out in this order versus all these other options, here's what it would look like from a tax perspective and an investment perspective, and then allow you to make those best decisions and then hold you kind of just accountable for making sure we're sticking to the plans. But basically it's saying, like, should you take money only from your IRAs first and delay Social Security, or should you be taking money out from both, or realize some capital gains 1 year, then start doing the Roth conversion? So everybody should have a primary order of withdrawal strategy and a secondary order of withdrawal strategy. Basically saying if markets were to go up, you do this. If markets go down, you do this. If taxes go up, you do this. If you have a one-time expense, you need money, you have a plan in place to kind of where it's going to come from.
Now I'm going to switch some gears here, and we just talked about taxes and tax planning, and we're going to move over now to the investment side of things and just kind of give some information about investments, sequence of returns. But before we get into sequence of returns, I want to mention something about the U.S. stock market, more specifically the S&P 500, which when we talk to some clients or potential clients, they find this very interesting. The S&P 500 has averaged a 9.7% annual return since 1994, 9.7% annual return. However, the craziest parts of this is, number one, stocks, that market has never hit the average return each year. Never has the return of the stock market historically of the S&P 500 actually been for 1 year 9.7%. Number two is stocks have more 20% plus years than total down years. 11 times since 1994, this S&P 500 has had a 20% plus year, and only 8 times has the S&P 500 since 1994 actually had a total down year. And the third and final crazy thing is that stocks are up on average 3 out of every 4 years. And the reason that last part's important there, 3 out of every 4 years, is because for this married couple specifically, sequence of returns actually helped them because when they retired, we entered into a bull market beginning of 2023, but that's not always the case. So I want to kind of talk about sequence of returns risk and why that's important when it comes to retirement.
Yeah, I love, having this type of information and being able to explain to somebody because a lot of that logic out there stuff they heard is just invest in the S&P and you'll get 8 9 10% returns, which from an average rate perspective that is true, but we also have to take into effect like this is so important about like when you retire and what happens next and how it happens is like super important, and that will basically dictate those first, I call it the fragile decade, those first 10 years of sequences. Like, are you going to get the plus 20s, or are you going to get experiencing some of those years like 8 years where you had those negative returns and the markets are down years? What are you going to experience early on in retirement, and like what type of withdrawal strategies are you going to have in place to basically counteract what's happening in the market? So let's just do some education here from an investment perspective. You have to understand like there's basically two phases: your accumulation versus your distribution. And most of you are pretty accustomed to accumulating assets and watching your accounts grow. Funding 401ks and watching the stock markets go up and writing out bear markets and saying, hey, my 401k or my pie chart at this wirehouse has never failed to recover from one of those market dips before. And I'd say you're 100% correct. Almost every stock market chart you look at, even you zoom out, it's going to go like up and to the right. Every single one is up and to the right. It's not a straight linear line, but up and to the right. So from accumulation perspective, you have to understand like really, if we had two individuals that invested 100 grand and just parked and prayed it and then never looked at it again, and they both averaged 8%. One started accumulating in a bear market and one started accumulating in a bull market. They both averaged 8% long-term, no withdrawals, no contributions. They're both, after 25 years, they're both going to have the same portfolio balance of about $735,000. Like buying and holding and never touching it again, the average rate of return will equate long-term. We have to make sure we understand how these rules work. What does it look like as we're decumulating or taking money out? Does the sequence of returns risk really matter? So if we can look here, this is an example. We have basically the same two investors are saying, hey, I'm going to take out 5% of that portfolio value. Remember, that's about 735,000 and change. I'm going to take out about, 5%. Sounds good. And then I'm going to increase that with inflation every year of around 3% to equate for that. Does the sequence of returns risk matter now? The fragile decade? So they're both going to average 8% over 25 years. Unfortunately, portfolio A retired at the wrong time. And then portfolio B retired at the right time. And as you can see here, like at age 83, portfolio A, individual A, household A, they basically ran out of money. Not because they weren't doing anything correctly, they just made the assumptions. So obviously, would they have run out of money? No, they probably would have made some adjustments to kind of get everything back on track. But portfolio B is a good reminder because like this reminds me of this household. They had super high withdrawal rates early in retirement and they retired into a good market. But the question was like, what happens if they did not experience that? What happens when you're taking out not 5%, but 8% withdrawal rates, 9% withdrawal rates early on, and you would have experienced a down market? So again, most people are like, hey, Kyle, give me household B over here. I get a bull market. I have a bear market later in retirement. I average 8%. I retired with 735. I got about $1.3 million in income, and my portfolio balance at 93 million. Sign me up. And like this is kind of like what a lot of people are saying in like Monte Carlo analysis is like this household, I would basically say portfolio B is you probably underspent in retirement. Like you retired with 735, and then like 30 years later, you had $3 million. So like the better plan would have been on like how could you have spent more early on in retirement? So that's just addressing sequence of returns risk. I just want to bring up one more scenario. Like we have a brother. Two brothers like Steve and Bill. Let's just say there's a 10-year age gap, and like your first 10 years are the most important. Like I just always tell people this is like from a behavioral perspective. We also talk about return on investments a lot, but I want to talk about return on your sleep, like being able to sleep at night. You can't put a price tag on that. Well, let's just say Steve retired in 1990 and Bill retired in 2000. Okay, two different decades, the exact same investment. This is like the Dow Jones Industrial Average. They both had $500,000, and then you can look at their market returns in 19. Basically, Bill was taking out $30,000 a year fixed, never made adjustments for inflation. He had $1.2 million at the end of 1999. Sign me up. That sounds great, right? Bill's like, all right, I'm ready to retire. And he goes in and retires in 2000. He's taken out $30,000 a year, also started with 500,000, and he's down to $156,000. He retired into the lost decade. He had two major market dips in his first 10 years. Again, am I trying to like scare people or be a doomsday or no? But if we're just making assumptions saying like the markets are going to average 8 or 9, you have to take into effect like what type of sequence of returns risk are you going to take on and make plans for both types of scenarios. So this is a good reminder, like that's $1 million portfolio difference after just like the first 10 years with the same starting amount and the same withdrawals.
Yeah, so if we go back to the plan that we were talking about at the beginning, the married couple, $1.5 million, can we walk through some tax planning, some just overall retirement planning suggestions that, this couple was given?
Yeah, so just this is not advice to you or the viewers or listeners, but like from their perspective to address some of their concerns. Like remember some of their concerns were like having way too much in tax deferred or hey, what happens if the markets go down? The best way from a spending and tax and longevity perspective was to allow them to actually, we're going to take their Social Security a little earlier than what they thought they were going to do. So this household, the plan actually indicated that was implemented and showed like multiple scenarios were looked at. Is we were going to take Social Security like in 2025, January 2025, we're going to take it. It did not make sense to continue super high withdrawal rates early in retirement, even though they could probably afford that as long as the markets were up. It was more impactful for us to take Social Security a couple of years earlier, and then start doing Roth conversions, because what more than likely Roth conversion strategies won't make sense if you're going to have super high withdrawal rates from your tax deferred, and then you have to do Roth conversions and then pay the taxes from the Roth conversions. That's really not going to work. So Social Security was going to have to be taken a couple of years earlier. And from a numbers perspective, why they decided to do that, why it made sense after looking at multiple options, like taking it January 2025 versus like both of them waiting till 70, like from a cumulative break-even perspective, it didn't break even till like age 83. So age 83, like that's when everything would have broke even from just like Social Security. And they could sleep at night knowing like, hey, if we're still living after 83, let's just say they're 90 years old, like they potentially could have left almost $200,000 in Social Security income on the table if they would have waited. But they're okay making that decision because really early in life is when they wanted to be able to spend more and then do all this tax planning up front versus like at the end of life being able to have more Social Security income coming in. So we're going to make sure that knowing that their Social Security is going to be taken a little bit earlier, we might ramp up the growth on their equities to equate for like longevity risk. So from a Social Security perspective, like they could afford to do that. And if we look at like spending capacity, like what they're spending right now is a good number. We probably wouldn't keep that up forever, but I would say a good spending capacity for them would be about 8,000 to 8,500. Taking Social Security January 1, 2025. And one of their main concerns was like, hey, what happens when the markets go down? So if we can kind of implement this plan and monitor and make it an adjustment, really their portfolio would need to fall about 30%, or it would need to fall to about $900,000. And they would have to cut their income by about $1,000 per month. So not a major adjustment, but basically we're basically lining out to say, hey, if the market drops 30%, or if your portfolio, not the market, were to drop 30% or to $900,000, you need to adjust your net income by about $1,000 per month. So they like the idea of just having that data and information so they can make decisions in their best interest moving forward. And even like delaying Social Security didn't impact that. So that's why it even made more sense to do that earlier on. And then the last thing is we're going to start Roth conversions in 2024, 2025, 2026, 2027. At a minimum, they needed to do about $50,000 of Roth conversions each year. So that way, this tax trap that was waiting for them at age 73 didn't like bump them up with effective tax rates. They wanted to make sure like the surviving spouse, if one spouse passed and the other one kept living, that they didn't like lose a Social Security check and then jump into a higher tax bracket. So they wanted to make sure there was enough Roth conversions going on. So really the plan said at a minimum $317,000 needed to be converted between now and like 2030. So that's really like the summary from to address their concerns as much as possible.
Yeah, so Kyle, what can the listeners take away from this? What actions can they take from this as they hear about sequence of returns and tax planning and hearing about this case study as well? What is the action item that listeners can take from this episode?
Stay away from cookie cutter rules of thumb, like, hey, my Social Security statement says the longer I wait, the more I get. Yes, potentially some households need to wait. Some households can afford to take it on. It really comes down to doing these action items. One, what type of spending lifestyle do you want in retirement? Because most people can't answer that. Is it static? Is it going to be dynamic and like spend more earlier on? And when the markets go down, like what type of adjustments do you want to have to make? Like not at all, or early on, no adjustments, spend more. So do this. Create a comprehensive retirement plan that's more than pie charts. Like build it yourself, go through tax and income and Social Security planning and investments, or pay someone to do it for you. And then really decide, can you live your best pre-retirement and retirement life doing this all yourself and making these adjustments and constantly doing ongoing monitoring and planning? Or are you better off paying somebody else to do this that's not just going to give you pie charts? They're going to give you pie charts and the planning. That's really like my action item for people to consider, is like, don't make assumptions, do the plan, and then can you live your best life doing it yourself or having someone else do it for you? And then like, what are the pros and cons of doing that?
Yeah, well, there's the episode talking about a married couple retired just about a little over a year ago with $1.5 million, all in pre-tax, talking about sequence of returns, tax planning, and then, you know, their Roth conversion strategy that we gave them for what they could do. So that is the episode. Thank you all for listening, and we'll see you next week. Goodbye.
You've been listening to Retire Ready with Kyle Hammerschmidt. Planning your retirement starts now. The word retirement shouldn't scare you. Our passion is to be here to help you navigate every step of the way. We hope you've enjoyed the show. If you did, make sure to like, rate, and review. We'll be back soon. But in the meantime, for more education and information, hit up retirereadyacademy.org. And if you're ready to start your retirement planning today, go to our website at mocanwealth.com. Mocan Wealth Management is a registered investment advisor with the state of Kansas and Missouri and may only transact business with residents of those states or residents of other states where otherwise legally permitted, subject to exemption or exclusion from registration requirements. This communication is not intended as an offer or solicitation to buy, hold, or sell any financial instrument or investment advisory services.